Everybody. Happy 2026 to everyone. This is our first macro meeting for the GoldFields Fund in 2026. We're going to do a review of the most important macroeconomic factors. We do an official meeting in Portuguese, but I'm also recording one in English so we can broadcast it to more people, as the main intent of this channel is education. Okay, so starting with this week, we have first of all, I'd like to introduce myself because it's the first class in English. I'm a portfolio manager authorized by the CVM, which is the Brazilian equivalent of the SEC. I've been in the financial market since 1997. I'm working on several large international institutions as a market maker, foreign exchange trader, interest rate trader. So I've been pretty much around. I've seen everything, lots of crises and crashes and bull markets, etc. I worked on trading desks in São Paulo, London, New York. I was lucky enough to work with very bright and intelligent people who taught me a lot during this journey. I'm very thankful. And we do to sum up, we do on these meetings we do an overview of some uh, important areas that we may think will affect the market and our positions. And we are open to suggestions and hope you like it. Okay, thank you. Let's begin. So for this week, we have the news that the U.S. has captured Maduro. Everybody has heard about it already, and we know that the oil from Venezuela is a heavy version of oil, which is mainly used to convert into diesel. Venezuela used to supply almost 3 million barrels a day in the past, and this number has collapsed 1 million barrels per day only. Well, the market has the USA and the market has the hopes of reviving it, and logistically speaking, could be a good idea because the Gulf refiners are close to the Caribbean shores of Venezuela, and even though they have been working at almost full capacity, and the fracking spreads are expensive right now, so we have to increase the supply of oil, but we also have to increase the refining capacity. So it will take some time. Okay. Without this geopolitical tension, we have gold and silver keep exploding higher this morning, and mainly because I think the market fears there may be a reaction from China or other countries that may not like the U.S. flexing its muscles in Latin America. And we don't know what will happen, but the market, has always looking for hedges for worst case scenarios. One thing to note also regarding Japan, which is a major market, that the long yields have spiked, but the monetary base there has been contracting. So in that scenario, typically when you have rates going up, you also have money creation. The market gets scared and pushes rates up. In this case, we ask ourselves if soon they will have a crunch. Will the yen strengthen that scenario? We don't know. Uh, this could bring some stress to the markets also, right? And then we always have to look at Brazil because Brazil is our main portfolio component since we are living here. In Brazil, we have political issues back on the spotlight because of the relation with Maduro and Lula. Uh, uh, the Latam market has been a good performer last year, second best performer in all asset classes, and we still have emerging market flows, inflows towards Brazilian ETFs and emerging market ETFs. This has been helping the markets here. Okay, So beginning with USA, we always do liquidity watch. We rely a lot on cross-border capital. I like Michael Howell's work a lot. Uh, and we know that at the end of the year, the market has been greeted with the interventions by the US Fed. In Michael Ward's newly minted RMP, Reserve Management Purchase Liquidity Program. It is worth saying that policymakers are simply reacting to rising tensions in funding markets, which means they are not openly doing QE or something very relevant. They're just putting off some fires in the market. And so this could still favor the US dollar if the market is viewed as being tight. Okay. You see here we have the spread between the SOFR, which is government-backed collateral, overnight money changing hands, but with government-backed collateral is a SOFR equivalent to the Selic in Brazil, and that's plotted against Fed funds, which is private collateral, and in Brazil would be the equivalent of CDI. CDI in Brazil is very small; it's a very small market. As opposed to the US, where private market for overnight funding is much bigger. But anyway, you see there's some stress, probably because bank reserves have been fought after the down of reverse repo operations, and on the past quantitative tightening, which has been uh, paused by the Fed right now, okay? Because it was already eating into bank reserves. Well, regarding global liquidity, we know that Bitcoin, gold, equities, they are real estate, they are related to how much liquidity you have in the system. So we can see that there was a negative reaction in the last few months because of liquidities being pulled out, especially in US dollars. So Bitcoin has suffered a bit. A lot of people expect monetization because of the large fiscal deficits. The market sees the future monetization come back stronger again, and they buy Bitcoin, gold, and silver, all tangible assets as hedges. So mainly, I think market has been positioned very long, and that's one of the reasons it has fallen down, apart from the liquidity issue. But I think people still view this more of a buying opportunity than to sell and wait for a panic. Okay, this is the reverse of overnight operations that I mentioned. They ballooned during the COVID rescue operations, because the Treasury issued checks to the regular people and they parked those money in bank accounts. So at the end of the day, the Fed had to withdraw this balance from the accounts, and this was in huge size. Now all this money has been put to work, uh, taking risk or going into money market funds or helping fund short-dated treasure operations. So anyway, the shock absorber here is much smaller. Money has been put to work. And here is what I was talking about. Bank reserves have reduced, and this is the reason why we have some funding stresses. Fed has acted a little bit here, and we'll see what happens going forward. Okay, I hope this doesn't spread into a full-blown crisis. So far, so good. Not happening too much. We like to follow. We're going to do a different study today when we talk about Brazil. We always watching monetary aggregates because everything is priced either in dollars or gold or Brazilian reais. So the more or less money you have in circulation, that is also priced in currency. The more or less you have a currency, uh, price will change. Okay, so it's very important to follow liquidity. M2 money supply in the US, we can see that there was a huge spike during the COVID uh, helicopter money, and after that, when inflation picked up, they reacted uh, right, rightfully, contracting money supply, which wasn't the case of Brazil. That's one of the reasons that the real has been weaker lately. And after that, they came back to normal levels. I think now it is running very closely to what the total bank credit is expanding, like 5% a year. And and also nominal GDP. Important to remember here that with the US growing the way they have been growing, more than 5% GDP, and keeping uh, their treasury debt short dated and in 375, this gives stability to the debt over the long term, and also cleans a little bit of debt depending on the debt size. But anyway, you have some stability. It won't compound uh, as if it would be the case of a nominal GDP smaller than the implied rates that the treasury is paying. Okay, nominal GCC. This is very correlated. This is M2 in red, uh, nominal GDP in blue. GDP deflator also related. M2 is more like a leading indicator for the rest, of course. Uh, Michael Hoyle has an opinion that to help fund the deficit, banks are going to be allowed to expand their leverage in the balance sheets. So they are not receiving, they'll be buying more treasuries via leverage and not via new money. So this is like monetization by the private sector. This could increase them to grow a yearly growth from 4 or 5% to 8%, and this won't be compatible with a 2% CPI. Right now, the market is very calm regarding inflation. Everyone expects, even the Cleveland Fed inflation outcasting or implied break-evens in the market. Everything is cool regarding inflation. Inflation is close to break-evens, uh, and but this since we watch the leading indicators, this could be a leading indicator that things may be about to change if it happens. Okay, we'll keep a close eye on that. Always remembering that the dollar is one of the few currencies, or perhaps the only few currency that appreciates when there is inflation, because the market has faith that the Fed is going to do the right thing and pull up rates to contain inflation. So uh, inflation goes up, the dollar may strengthen. I like this graphic because it gives us a sense of value during time. This is gold divided by M2. So right up here, gold is very cheap. Right down here, gold is expensive. We're approaching the 2011 levels where we last had a big realization. So slightly dangerous to be long here. Still, gold is a very important portfolio component anyway, but we have reduced our longs here due to risk management, and we'll see what happens. If we're gonna go uh, climb another 100% and reach the highs of the panic of 79 and 80, or we'll just hit the equivalent of 2011 and then come back again. We'll see. Only future will tell. So here I mentioned total bank credit growing in line with M2 money supply. This is actually good for equities and markets in general, because when the economy is growing too fast, rates may have to come up, and this will drain liquidity from the market. So medium a slightly warm rate of growth is good because private companies still pay down their debt, they service their debt. The market is liquid and equities don't feel the push of higher interest rates. So this is what is called a Goldilocks scenario. Inflation is cool too, and this tends to benefit equities. Here's the DXY, the basket of mainly G7 currencies against the dollar. Dollars, you can see this, the Trump took over has been weakening. And here we are on a sideways market right now. The market is trying to cross the weekly moving averages, but haven't done it yet. But we will see what happens. This is the probability from CME, from futures trading. The market expects no change for the next meeting. Keep them at 350%, 350 and three quarters, 375, 82% probability. But for March, it is split because 50% of maintaining, and if you sum up 25% drop and 50% drop, we always come to the almost the same 50%. Okay. I like this graphic because it shows monthly tariff revenue has grown since Trump has introduced the tariffs. It's gone up a lot. Always remembering if we annualize 30 billion a month, which is the current rate, we'll reach almost 400 billion. The deficit is almost 1.8 trillion, if I'm not mistaken. So we will be reducing the overall deficit by 25%, almost a quarter, which is a good thing. Uh, so we'll see. It looks pretty stable from here. I think unless there's a economic catastrophe or big recession, I think things tend to keep this way. Okay? There's nothing pointing to catastrophe now. Just market positioning that is maybe too bullish now, but we don't see credit problems or anything like that. Liquidity is slowing. This may be a problem in the future, but not like 2008, where banks were leveraged, the private sector was leveraged. Public sector has absorbed all this leverage, so probably keep a less volatile environment. Always look at the Atlanta Fed GDP now forecast. They only have one uh, data point so far, projecting 3% GDP for fourth, fourth quarter. Still, it is a strong number because this is real. This is nominal, less inflation. So if we have 2% inflation, we're talking about 5% nominal GDP. Still good for equities and private credit, okay? And also for government debt stability. Uh, Leading economic indicators. Here we have a conundrum, like Alan Greenspan used to say, because the leading numbers have been really going down fastly, and coincident numbers are steadily high rising, and this is showing us a big dichotomy between the two indicators. Don't know which one will prevail. We already here regarding the leading indicators. Only financial indicators are good because of the wealth effect of equities being expensive as they are. Uh, So we'll see what happens and what develops here. A lot of controversy between economists. Here's inflation forecasting. As I said, numbers were running on the hot 3% area. Now they are going down. CPI for December 2.6, the core, and the January lower 2.28, and the core 2.40, almost on target. We'll see if it develops. We'll probably have with oil at these levels. We probably had these numbers have a good chance of materializing. But going forward, if monetization continues, I think we will probably have a problem with inflation. Okay. Also look at break-even inflation, which is inflation implied on when you compare government bonds that pay dollars straight, no adjustments, just an interest rate in dollars against those that pay an interest rate plus an inflation rate. It could be CPI. And then when you divide the factor of one by the other, you get what the market is expecting as implied inflation. For 10 years now is 225, which is a benign, very benign number, close to the Federal Reserve's target. Okay, so that's why one of the reasons we have a bullish stance. Regarding treasuries, I think that it didn't hold on too long below 4% because of the numbers I just showed. Economy has been growing nominally, both in real and nominal terms. And now we are reaching a resistance here to 420. If we breach, we'll probably go to 435. There may be a trading opportunity here, but we're not doing anything, any position so far. This is a 10-year chips. It's paying inflation plus 192%. I like the trade of being long chips when they surpass the 2% real rate. I think 2% real rate is quite fair. Anyway, we still have like 10 basis points to get there. But after that, I would start accumulating, always remembering that those are 10-year bonds and they have some volatility. Okay, if this thing goes through, portfolio can suffer. So always keep that in mind. Private credit spreads still close to the lows. The economy growing steadily. The junk ETF also here is not a spread. This is the full price of a bond equivalent of a portfolio of junk bonds. We can see that it's almost on the highs. For economic calendar, we have from JP Morgan. It's very important. This Wednesday, automated data processing will release employment numbers. JOLTS, which is job openings. The Fed looks at these numbers. It's very important. Automated data processing is a company that processes data for other companies, like labor data, payments, etc. And they became so popular and famous. I think it was in the 80s that they started releasing their own statistics. And on Friday, we have then the government numbers from BLS, unemployment rate, average hourly earnings, and we also have big bond auctions on Thursday. It's going to be a pretty busy week. Speaking of equities, we have this study from Damodaran, the father of valuation. He does an exercise using earnings estimates from analysts. The treasury bond 4.16. The equity risk premium converges on 425%, which is the average premium between 1960 and 2024. He arrives at almost 6,000 points, 22 trailing PE price to earnings. Market now is trading higher, 6,900 nowadays. Well, you can pretty much justify the last year's rallies if we use these numbers. Anyway, I think it's interesting to see. Important to note that 2024, the S&P profits per share of the index were $242. They grew to 267. Now market expects it to grow to $305 now. which is pretty impressive. And we have a lot of concentration, which causes some concern in the American market. American market now responds for 70% of the world's market cap. And it is nice to notice here on this study from JP Morgan that United States is the market where the expansion has been mainly based on earnings per share growth as opposed to multiple compression or something like that. So this is interesting, which means that the economy and their companies are really reverting more revenues into profits as compared to anybody else. Looking at NVIDIA, very important component of the index. This, to me, this looks like a sideways market, not much fun here. MicroStrategy, which owns Bitcoin, is like a leveraged version of Bitcoin, still suffering here. We'll see what happens. January, you have this statistic that on average tends to be a positive month for equities. The S&P here is clearly on an uptrend. It's like a textbook uptrend. It's amazing how all the tips are being taken as buying opportunities. But when you divide it by real currency, real hard currency, which in my opinion is gold is money, right? You see that the S&P is not rallying that much because gold has been going up even more. I like to look at the equities bond ratio. This has been impressive, which this means this graphic mainly is the SPY ETF divided by the TLT long bond ETF. And the ratio has been going up because here, what is embedded here is America strong. These equities go up, rates also go up. The economy doesn't care. It can sustain higher rates, keep growing. So you have higher equities, higher rates, and the spread keeps pushing to new highs. It's amazing. If there's any sign of recession, this will probably quickly turn because then long bonds will spike up and equities may fall. But so far, this trade has been dreadful, it's been terrible for those who shorted it. The IWM, small caps in USA, they have been lagging for a while. A lot of people mentioned the rotation trade hasn't happened yet. To see. We also look at KBWB, the big banks. The big banks are the arteries and veins that irrigates blood to the economic system. So it is always important to look at them. And here we see nobody forecasts any problem. They are reaching new highs. So this is good omen for the US economy. Regional banks, on the other hand, they're still big, but not as big as the big banks. Keep an eye on them also. Home builders, another very sensitive area, cyclical area. They are muddling around the moving averages. This is a sideways. It is a market that got a lot of traders killed because here everyone said, "Oh, the Fed's going to put the rates at 5%. The real estate market will collapse," but it never happened. So it was a mother of all short squeezes here. And now the market has, after all this huge rally, the market has naturally lateralized, but it's still very volatile. So we'll keep an eye here. We always follow this very important asset. Walmart is another one. Walmart is a big retailer, so strength in a big retailer. I think here there's a bit of a case of people buying less expensive products because they have been affordability crisis because of COVID inflation has been putting a lot of pressure on families and households. So either Walmart here is telling us that the economy is strong, or it's telling us that people are switching their consumer preferences to cheaper products. Okay, and this is another indicator that I like to watch, which it gives you the S&P 500 in real money, because we adjust the money supply to the index, and we see that only now we are reaching the levels of 1999, 2000, and you can see how cheap it was, because here there was credit and money destruction, and also the exchange, the index collapse. Then they started rescuing the system and pouring money into banks, and the trend has reversed. But now we are reaching a dangerous area here. Okay, at least in my opinion. We also look at the volatility index, the CBOE. Uh, let's see, let's see. They measure the front end implied volatility. It's not the greatest indicator, but it's the one that everyone is watching. So a low level like this means less panic, market more relaxed, and this is prone to bigger realizations if they happen. I personally have learned from my former master and boss to look at the implied correlation between the index components and the index volatility, because supply and demand may distort this, but in the end, what it means is that market is pricing that nothing is going to happen too much with the index, and equities will keep moving, uh, not in tandem. One day you will have energy stocks up, technology down, the other day reverses, technology up, energy stocks down. Correlation is low, the market goes nowhere, implied volatilities on the index collapse. This is like a warning signal, because there's very low fat to eat here, and the premiums are becoming less and less fatty. So if there's any problem, the relation here for a gamma theta is going to be very against the short seller, and then we may have a short cover in the market and some stress. Okay. I also doubt I would put a play here. I think that if here is a correlation implied on the 90 deltas, 70 deltas, 50 deltas, and 10 deltas. I think that the market really trades close to the 90 deltas. The actual correlation is going to be much higher than 30. I can't figure out why, but I try to think about it, why it is trading at 30 now. And here we have term structure, same as implied volatility. For implied correlation on the front end is very low, and in general the curve is historically, compared to the average, is very low. But when it's upward sloping like this, means that this is very pressure on the downside. People are short vols, expecting no moves, and then the moves happen. You know how it is, right? So to sum up the US part, I would recommend some caution, because markets are well positioned for bullishness already. Valuations are slightly stretched, a lot of concentration. Implied volatilities don't give much room for realization. So I know that the trend is continuing, the market is pushing upwards, but we know that those things change quickly. So you can still have a long position as long as you have a tight stop, or diminish the position and diminish your risks. Okay. I'm not saying that I don't like US equities as an asset class as a whole, but I think at these prices you have to be careful. Financial markets, everything is a matter of price, right? How much you're paying and what value you're getting, as Warren Buffett would say. For the international part here, we have Italian bond yields 354. They just had an upgrade. Italy to 2012 during the European crisis was one of the ugly ducks. But nowadays they have uh, managed to recover a lot of the reforms that they needed, to put in place reforms that they needed, and save some spare some money from government spending. So everything is going on a positive direction. And now Italy pays less spend than France, which in the past was unthinkable. France is much more in a mess of a fis- fiscal situation. Equities have been going up because they still support a lot to China, and equities can be viewed as a hard asset uh, that protects you from eventual devaluation of the currency. And now we also have to talk about China, right? China was injecting a lot of liquidity like 2 or 3 months ago, but now it seems that they have paused it a little bit, uh, probably being afraid of the yuan losing value. And since some good analysts say that Asian currencies are the main point now of distortion in the market, they are overly undervalued. Uh, so the moment the People's Bank of China stop injecting so much liquidity, the yuan appreciated very quickly. Here's the iron ore price, which is zigzagging pretty much, more bullish than bearish. Bond yields in China, the bonds in China is between the major countries are the only ones that have had positive dollar returns over a span of 5 years. And here is the USD CNY graphic I spoke about. Some acceleration on the downside here. China has like a $1 trillion surplus in goods. So this is amazing. This is a result of that also. Chinese stocks have also been on the climb. If we reach this level, we'll probably go much higher. China seems to be in the beginning of a cycle where they were having, they're leaving their deflationary problems and may start to reflate and inflate, and this can be very bullish for equities. Okay, this is a basket of emerging market currencies against the dollar that the Fed distributes via their site. We had some pressure at the end of the year. Some companies uh, moving dividends back to their headquarters, and now it has moved on the other side, and we have once again flows to emerging markets and emerging market currencies strengthening. Here's a pair that, because of all this situation, oil in Venezuela is a pair that is worth watching, which is the amount of Norwegian krones you have to use to buy in euros. So if it goes up, means that Norwegian krones are losing value, and probably that the oil is going down. But you can see, but today the spike was very small. Market wasn't much concerned with the Maduro operation. Okay. Here's a study of from HSBC. Speaking of Britain, the 10-year in Britain also trades now higher than the US at 450. Market that expects inflation to cool, labor market to cool, and the fiscal situation is still somehow messy, and they are trying to address it. But let's see if the market buys the theories or not. Okay. Yeah, and the pound has been strong lately. pretty much in a sideways market after the big Trump rally and the dollar sell off. Uh, anyway, here we will be sellers if this moves towards 140 again. Germany, impressive how rates are going up. They have made the pledge to spend more, especially on military and scientific development on military. And if we breach this 290 level and go to 3, uh, we may see some stress in the market because it's a whole new level that hasn't been reached for a lot of time now. So let's keep an eye here. The DAX, amazing how everyone talks about how Germany is losing its prowess as an exporter. But their companies are climbing to new highs. You can clearly see that we broke through a pivot here. Now we have uncharted territories here and going to new highs. Trend followers are probably going to be buying here. The euro, another one in a sideways market. We don't have much of a view for euros now. Their rates are very low compared to dollars. The flow is also is more euro supportive than dollar now, but we are not doing anything here. Japan is an interesting case, as I said. Last GDP number, nominal GDP was contracting, and their monetary base is contracting by 8% in a yearly clip. And at the same time, yields are spiking to 11. This may cause some stress in the future because uh, economy will slow down, government revenues will slow down, and rates are going up. Or the market may soon wake up to the fact that you're receiving more yield in a currency that is being less diluted. So this can be supportive in the future. Okay. So far, it's not what's happening. The yen is being very weak. A lot of travelers that go there said that Japan hasn't been this cheap for more than 40 years. Their equities have been also a defending real tangible asset against monetization. So they are climbing to new highs. And oil here is our king oil, very, very pressured, keeping CPI and other inflation indicators low. And if we look at the financial commodities ratio, which is mainly gold and silver compared to industrial commodities like gold, we are reaching the COVID lows. It's amazing. The amount of oil that you buy with an ounce of gold is at the high said. Okay. This can be bullish for gold in the future, but nowadays, who am I to fight the trend? Okay. So here we have gold climbing this morning because of geopolitical tensions. No news in monetary front. Copper is another one who is trying to breach all-time highs. If it does, we'll probably go much higher. And still, on the other hand, it's been a very steady, not on a trend market. There's been much of a sideways market here. China has some spare capacity. Aluminum is one of our surprises here. See, aluminum that's climbed up steadily, reaching the level lastly seen in 2022. We know that aluminum is a proxy for some electric components in substituting copper, which is more expensive. So that's probably the case behind it. And silver, here we have silver mania. Silver mania Silver was very cheap with its spread divided by the gold price. And finally, the market woke up to that fact, and it was an impressive rally in 2 months, only from $48 to like $80, almost doubling. But in the past, it was like this also. But if you adjust, if you think that silver traded at $50 in 1980, and you adjust for so much money has been created, so much money and wealth, and adjust for nowadays, my goodness, this could be a much higher price. Don't know what happened here. So anyway, we have reduced some loans that we used to have. Soy, which is important for Brazil exporting, suffered a bit in the last few days. Same for wheat. Wheat is more exported by northern countries, and in the south we have Argentina. So investment conclusions, I derived some from Michael Howe. I agree with him. Do not chase risk now. We are not in a risk-off environment yet, but we're still on risk on, which makes it slightly dangerous. So I wouldn't be chasing risk here. Perhaps maybe in some markets like Brazil, if we really have this political change possibility in our minds. Otherwise, I think sooner or later we'll see a big stress. Well, let's talk more about Brazil then. So I took this from my friend Rodrigo. Thank you, Rodrigo, for sharing this table. We can see that last year the Brazil ETF went up by 51% in dollar, which is a lot. But 5-year compounded return is only 5.5% on a much higher volatility, which gives us a very poor Sharpe ratio. Sharpe ratio here has been good for the last year. But when portfolio managers look at these things, they have much more liquidity, less volatility, and more returns here. So why bother going to more exotic places to trade? So one of the reasons that we have this feeding mechanism where the American exceptionalism keeps being fed and it never changes. We do have a bullish stance in Brazil. We had it some 2 or 3 months ago. Market went up, we reduced a bit. Actually, it's 2/3 of full VAR that we can have. We still think the market here can green higher because commodities are approaching a bullish season, at least in our opinion. For Brazil presidential election, since Flávio Bolsonaro received support of his father, the cards have been all messed up. Lula has gone up, reaching 50% chance again, and now we have 15% spread between Flávio and Tarcísio, which is small if you think the market wants to have some change. So it's not left to go higher. Here we have a lot of people giving Lula as elected. Okay, there's a study by BTG Pactual, which is very interesting, that says the Brazilian Bovespa has not been the Brazilian index. It's not on the lows, but it's still cheap. Still one standard deviation from the average. If you take Petrobras and Vale from the sample, they trade at 10.6 forward, 1 year forward PE. And if you include them, 9.1 against the average of 11.9. This is slightly cheap against the average. But when you use earnings yield, it is not so cheap because real rates of Brazilian government bonds are not going much lower Actually, they have been climbing during the last year, and only for the last 60 days, I think they have been uh, moving lower. So when you compare, of course, the rate of return in equities with the lower P is higher, but then you compare that to a higher interest rate and a government inflation protected government bond, so the difference is not so big. We have from JP Morgan emerging market money trail, still positive flows from for emerging markets in Brazil receiving some. Foreigners have been buyers. This is accumulated. This is for my friends at Jumba. Thank you, Jumba. Uh, they foreigners have been accumulating, not as much as they used to do in the past. Personal accounts have been buyers too, and financial institutions and funds have been sellers during the year. Uh, I have this comment from JP Morgan. It is a 2-month-old report, but it is interesting because they have the point, which I agree, that for the first time the Fed is cutting rates, and we are not on an emergency, in an emergency. Okay, so it is cutting rates in a regular economic scenario. This could be very bullish for emerging markets, Brazil included. They have this prognostic of Selic going down 425 basis points starting in December, which has not happened, bringing the Selic to 10.75. I'm not sure if they changed it, but anyway, it's still a very bullish call. I think that because of nominal GDP in Brazil, which is running now at 7 to 8% clip, a Selic of 15% is very contractionary, so there will be a lot of pressure to reduce it. I'm not sure it can reach 10% without political change. Without political change, I think it's hard. But we can see what is priced in the market, 12, 12.50, 12 something. Now we're going to talk about FX, Câmbio in Portuguese. So BTG does this very nice job of looking at central bank numbers and making them into a report which is very friendly for us to read. We had on the last week of December, third week of December, we still have the same playbook of the months before, which is trade balance brings in dollars to Brazil, and Brazilians take money out as financial flows. In December, this is more exacerbated by companies sending some of their profits and dividends abroad. Companies that are, for example, you have a car maker here, which is based in US or China. They make a profit here. They send it to their headquarters back. So this puts some pressure in the seasonality of December in the foreign exchange. But still some same thing, financial outflows and trade inflows. So far this year, we still have financial outflows, more outflows than inflows from trade. Very interesting to notice that even when market-friendly Jair Bolsonaro was elected into 2019 and 2020, there were large outflows. And 2019 was before COVID. Never forget that. Last time we had huge inflows was in this 3-year period from 2009 2012. The dollar real reached here a level of 165, and Brazil was very expensive back then. Remember that apartments in Miami were more cheaper than apartments in São Paulo, which by far is not the case nowadays. Here's a graphic of dollar real. I think that is a good entry point here to buy dollars if we get below 540. We also have the news that Chinese are going to tax Brazilian beef exporters surpass a certain level. I think it's 1 million tons. This could cost Brazil $2.5 billion yearly in the worst case scenario. from the trade balance. But the news came out yesterday. The market did not stress on that today. Uh, And now here comes the study that I made, which I think is an interesting one, because when we are comparing two currencies, one of the ways we can, apart from financial flows, productivity, economic productivity, etc., 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 a very simple way is just to compare how much currency you created in one country versus how much currency you created in the other. We're going to use the M2 criteria because the Federal Reserve goes only up to M2. In Brazil, we could use M3 and M4, but don't have them in the US. So we want to compare apples with apples. So we're going to use M2. We're going to take a starting foreign exchange rate and adjust that through time using the difference between the rate of growth of M2 in the two countries. Okay. So if we start when large government interventions began in 2008, the real back then stressed from 170, 180, if I'm not mistaken, to 50. We're beginning the study at 250. The red line is the line that is M2 adjusted, and the blue line is the market real prices. They pretty much converge, which is very interesting. We could easily have a 574 FX rate now using M2 criteria, especially because you can see here after 2021, 2022, the US started to contract money supply and we didn't. Okay. Uh, so in this criteria, a weak dollar can be a buying opportunity, right? If we start from the low point of 2011, of course, this was so low, such a distorted point that still nowadays, even after all the money Brazil manufactured in excess of the USA, we still have a 3.12 rate compared to 5.45, which is the market now. And here it is. If you start from COVID, then Brazil performs much worse. We could easily be at 7 exchange rate. We are trading at 5.45. Next slide, I'm going to show this in a different way, under base. So we starting right before I took the decision to place it right before the COVID intervention. 100 base for both. The red is a USA, so 57%, and Brazil has more than double, 265%. So that's the amount of M2 money circulating in the economy. Of course, there are some difference between the accounting methods of both countries, but still, since we're looking at the radius of the rate of change, I think it is decent to use it, okay? Now, making a joke here, the Uncle Domicio ratio, which I just was thinking to myself, there are two things that we could look. We could look at, as the past slides, only money circulation, and we could look at the ratio of money expansion, money in circulation expansion, the rate of growth of M2 compared to overnight interest rates. Why? Because you can be expanding your monetary base at 5%, but if you have an overnight rate of 11%, you're being contractionary. A lot of people will be parking their money in saving the deposits, and actually you are having an economic advantage of 6% every year. Your money will be stronger by the time, the money that you save. So what I did was take in blue is the rate of expansion or contraction, which is or money supply less overnight rate. So when overnight rate is higher than money supply, we have a negative value. See Brazil here after the first Lula election, when the real went crazy, the market went crazy. They kept the Selic much higher than the monetary base expansion, and this made the green line, which is the exchange between real and dollars, to collapse. Then we had the crisis of 2007, 2008. Wow, surprisingly, Brazil abused more than the US, the place where the crisis was happening. And this also caused a spike in the foreign exchange. What a coincidence! And then going to the future, you can see that the area, because the US was given the right to keep rates so low while they still manufactured money, um, they created more currency in regards to overnight rates than we did. So if you look at currency creation purely, Brazil wins. If you look at currency creation discounted by overnight rates, the US wins. I was surprised by that. But you can pretty much see, because we don't have their reputation when both go together. There's probably a crisis going on, and our FX rate suffers a lot. But here you can clearly see that Brazil was still the blue here. Brazil was still expanding. The US was contracting. So this was probably the main proportion for the real to test the sixth area. Now Brazil is going into contraction. The US is slightly turning to expansion, but very timidly. But this wasn't enough to make the exchange rates correct by a lot. So we're gonna zoom in this graphic now. Uh, Sorry, this is the zoom. You see Brazil after, well, we moved together in COVID, and then after COVID, we behaved more expensively than the US. That's the reason why this happened. And now, since we're a contraction, the central bank did the right thing, pulled the Selic rate up. That's the reason why the real has been appreciating. Apart from the dollar factors and the fact that Trump has been forcing the dollar to be uh, weaker to try and reindustrialize the USA. Okay. Still, in Brazil, we have the exporting four most exported products for Brazil. Most important ones are uh, oil and its derivative, uh, oil and its byproducts, 57 billion. Then soy, then iron ore, and then meats. Those are the main exports of Brazil. We still look like a big farm after all, but hopefully we can change that in the future. Uh, uh, Now we're going to talk about the fiscal numbers. Well, Brazil has been trying to have a zero primary result. The recurring has been more close to 1%. I always remember in the US it's 3.5 on the primary. But our problem is that our nominal deficit is huge. The only advantage that if a market-friendly politician comes into power, our rates probably go from 15 to what, 8, 9%, and then the burden of interest payments will go down a lot, and then this nominal deficit can reduce quickly from the 8, 9% that we are now to 5 or perhaps 4, and we create a positive feedback loop in the Brazilian economy. But we need this spark. We need to have a credible, market-friendly, a saver in charge of politics. Okay. Here I use M4 money supply expansion and Here is the current inflation rate, Selic rate here on this darker blue line. This is to tell the story that pretty much whenever you have a deviation, for example, during COVID, you couldn't intervene creating a lot of currency, at the same time reducing rates. The market is not dumb, so it reacted, pushing the exchange rate higher. This was once again tried here when Lula started in the president, as president. You can see the monetary expansion accelerated, probably mainly due to government deficit and funding, because M4 also captures government bonds in the system. So it was raising steadily, and they tried to reverse to move Selic on the other way around, lower. And then what happens? Currency depreciation. If current inflation was also, this is the IPCA, consumer inflation was starting to roll higher. Central bank reacted quickly enough, so FX has come down. Inflation is probably going to come down. It's going to be good for popularity of Lula as inflation, at least for me. I think it's the most important factor, and affordability everywhere in the world, not only US, not only Brazil, everywhere. This is the other graphic just zoomed in. You can see whenever there is a discrepancy. Here we had a discrepancy, the FX rate ballooned. Central bank had to react to correct, and monetary expansion has slowed. Current inflation was going higher. Then it kept pace with monetary. Government once again tried to expand and reduce rates. The market did not like it. They had to react again. So last numbers for nominal GDP in Brazil, 8%. Selic 15, I think there's a big discrepancy here still. M4 is growing almost at 10%. Still some room to reduce Selic for 12%. So, interesting to note, because of this expansion and contraction being more volatile in Brazil and less constant than in the USA, that's one of the reasons why real estate prices have kept steady in Brazil. And because of all the currency that has been created, I think that some REITs, real estate exchange funds in Brazil are cheap now. They have an implied square feet price, which is cheap, historically speaking, adjusted by the monetary base. So there's an opportunity here, good yield, good price. And here we can see FIPZAP is like the Brazilian equivalent of Zillow index, Zillow for the US, for real estate. And you can see, I make a joke here, Uncle Domicio, contraction and expansion. You can see whenever you have a contraction, rate of expansion in real estate prices slows down by a lot. COVID, expansion, real estate prices react. Right after that, we came to a contraction, Selic higher than the monetary base. They lever, then they expand again, they go up. Now, contraction, they're beginning to fall. So this is the reason why you still have some good opportunities here, especially if rates normalize to a more civilized level, like 1 digit perhaps. There will be a lot of money to be made in real estate, some real estate funds here. Implied inflation in Brazil for almost 10 years now, 580%, still much higher than the target, central bank target. Here is the DI future. It's pretty much on a consolidation here. This is January 27, which is more sensitive to monetary policy. It's just like 1 year less. Now is almost 1 year down the road. It projects an average of 1370 in this year, but there's some reduction implied. We'll get to that soon. Here is spot rates for Brazil and the is implied between them. Some vertices already pricing Selic of CDI of 12.25 is zoomed in. Here I do a small simulation. If the central bank cuts 50 basis in March, then accelerates to 75 on the next two meetings, and then gives another two meetings of 50, reaching 300 basis point cutting cycle. This January 27 that we saw on the graphic, which is today worth 13.70%, will be worth throughout time 13.20, and we have 50 basis points to make a P&L being long bonds, being long a bond or short the rate here. Okay. Brazilian Bovespa climbing to new highs. Money flows from abroad. The economy is still growing. You can justify also if you divide Bovespa by the money supply, you can see that it's still pretty much cheap. Here, because of what the oil crisis will bring today from JP Morgan, the reports that how much $55 barrel will impact free cash flow yield for these oil companies. First four are based in Brazil. The importance to note is that EWZ has reached a long-term downtrend. Now you can pretty much draw an uptrend here. Market tested the moving average and is going higher. This is a very bullish sign compared to EM, which is the other emerging markets. Brazil looks pretty cheap long term. Try to rally corrected with the Flávio Bolsonaro day. With gold, then with gold is tougher because gold has been rallying more than anything else. So Brazil is like very cheap in relation to gold, to real currency. Comparing to EWW, Mexico, Brazil looks cheap also. And against, this is Brazil against, I think it's IWM. Yeah, it's IWM. It's Small Caps USA. Has performed sideways, but long term still Brazil still losing. Here I like to look the ratio of small caps that suffer more with are more sensitive to interest rates in Brazil. I make a ratio of them. This shows that there's been some profit taking here on the small caps, and maybe a buy opportunity here, not on the lows yet. This is the same graphic long term, and this is the same graphic using the index versus Ambima's fixed rate bonds portfolio. This is more accurate because this has had the rollout effect on time. Here we had a rally in the correction, same as on the other graphic. But the thing here is that it can go higher because there's no much supply of new issuance of stocks coming into the market, but government, because of its nominal deficit, is always selling a lot of bonds in the market. So it's, even due to a supply issue here, this ratio can go higher, favoring equities. But in Brazil, it hasn't happened as aggressively as the USA, for example. We all look at the price of corn sideways. Coffee also after a big rally sideways. Here I bring an example just for you guys to see how important it is to watch monetary aggregates. We have the case of Turkey that expanded they try to create an economic boom, expanding credit and keeping rates, overnight rates, pinned at a low price. So they had like an average yearly ratio expansion of 56% of money supply. You can see what happened to their currency. Their currency was destroyed. It was trading at 6 at 2021, went to 34. So, and then you remember this period here, we have a 56% average expansion, and the overnight rate never surpassed 21. They try to force it to less than a digit. Market with all correctness panicked and bought the dollar, and they had to throw the towel and finally take the overnight rate to the same, almost to the same clip of a monetary expansion to contain currency devaluation and avoid hyperinflation. So you see, there's no miracle. There's no monetary medicine that can solve all problems. So I brought this as an example. I hope you guys liked it. Please subscribe and follow our channel. We'll do some short videos. I know this one has been long, but there's a lot of subjects to be covered. And we always do, so you can see how we do in our funds on a weekly basis, how we address all these numbers and try to derive them from top to bottom into a portfolio of bonds and equities, mainly in Brazil, but also some abroad, commodities too. And that's it. I hope you guys like it. Have a nice week. Good luck. Bye bye.